Yeah, remember the name, Jas Takhar, best in the game. Mamba mentality in his own lane, so better pay attention to what he be saying. Get the message, ain't no question, giving advice for any investment. Welcome to the broadcast, the Jas Takhar Podcast.
Okay, so as I usually mention to everybody who's, taking their dog for a walk, listening while they're on their treadmill, I always tell you guys, get to the video aspect of the podcast because I want you to see the handsome and the beautiful people that are joining me on the couch. But today is special. Extra special. I'll tell you why. Because I'm obviously not in the fashion world, aka fashionistas or whatever you want to call them. But the guy with me today, you gotta see his outfit. And we're gonna give a shout out to the tailor. But welcome, John, first and foremost. How you doing?
Jas. Fantastic. Thank you.
Thank you for being here, brother. We gotta talk about the suit, man. I love the color.
Thank you.
It's obviously summer here today. In today's recording, we're somewhere in summer of 2023, July. I think we're in right now. Who did this for you? Who's the tailor? I see the custom inside. Like every day I'm hustling. I love Monopoly, one of my favorite board games. We're going to be speaking about how to create wealth through different strategies other than real estate. And I was kind of mentioning for 3.2 seconds off air with you, John, that like my viewers and listeners, a lot of them are real estate people. A lot of them are real estate agents. And so they get a good and a heavy dose of content through this podcast and through all my Instagram stuff about real estate. But why I wanted to bring you on today was to speak about other strategies that you're helping your clients with, friends and family, and things that you've done personally yourself, like the vehicle through life insurance. I've always heard things about this. I know nothing about it, and so I'm so excited. But before we go there, the suit.
So thanks. So my tailor's name is 𝘂𝗶𝗁. It's a short form for his actual real name. He's Cambodian, and his company's called 𝘊𝗷𝗱𝗍. He's down on Front Street. So this guy is amazing. He's done athletes. He's done celebrities. He's done Bay Street lawyers, big Bay Street guys. And I got introduced him by my accountant, and I love his work. And he's done several suits for me. This is the latest one he just did. This is the newest fabric from Ariston. It just came out. I said, I got to have that.
I'd like to think you did the suit just for the podcast today.
Well, actually, I literally just got it last week, and I said to my wife, I said, I'm going to wear that one.
I love it. Well, shout out to Sophie. She's in the background right now. Yeah. So the shoes though too, man. Like you got the whole get up, buddy. I'm really liking it. Like my guys and gals know I'm a jeans, runners, t-shirt kind of guy. Yeah. It's how I do my business. But I always tell people, like, if you feel comfortable in a suit, you look good in a suit, fuck, do it. Like, don't try to do the hoodie and the t-shirt because I'm telling you to, or you see me doing it. And you obviously look like fucking 10 plus today. Is this kind of the get up every day kind of to work? And
work, yeah, this is work. Yeah, I've got several suits that I've had made over the years, and I just when I go to work, I always want to look like $1 million. So whether you're rich, whether you're poor, look like you know your shit, look like $1 million, walk in with the confidence, and obviously I think a suit makes a man.
100%.
Right?
I think there's an aspect of that for sure, and I know my business partner Laura Stewart's going to be happy because that's probably the most that I've ever spoken about clothes. So like I know she's in and around, and she'll be happy as she listens. So let's get right into it, John. Talk to my viewers and listeners, because your content on Instagram, like I like to think my content's pretty good, from what I've heard from my community. But I was surfing through your stuff on Instagram today, and I was just looking at some of the tips that you give to help people create financial wealth. And my viewership and listenership probably ranges anywhere from, like, the heavy target is about like 25 to about 45, like that 20-year kind of gap. That's kind of my viewers and listeners. And those are the ones that I really want to help when it comes to saving money, certain tips. Like, I just don't think we obviously know that it's not being taught in school. And I'm not going to go on a rant on how they should be switching that and all that kind of stuff. I've done enough content around that, but it's guys like yourself. It's guys like, I'm trying to do it to the best of my ability. And there's a good amount of people on social that are starting to put out more content to help people save money, also make money, and understand the difference. But like, why did you get into this? Like, how did that journey start? Like, kind of like walk us through how you kind of got started with wanting to produce content around helping people with creating wealth.
Yeah, that's a good question. So I got started kind of like you. You work for CIBC.
Yeah.
I got started in the business in 1999 with CIBC, and I was on the Imperial Service side.
Okay.
And I was a high level 7 advisor. And
Where?
Brampton.
Okay, so like Brampton, like at a branch kind of?
At a branch,
Okay,
yeah.
got it. I used to be at the Yonge and Finch at the telephone banking / 1990. I was there in 1990. No, I was there in 2000, where online banking was just getting started.
Okay.
And for the viewers who, when he says Imperial Service, like I knew exactly who he's talking about. That's like the top notch upper echelon of CIBC clients.
Yeah. So I started there, and the reason why I got into banking was, when I was in my early 20s, I had started a business and ran that for several years, sold my company, and had a ton of cash. And I was like 27 years old, don't know what to do. And, I'm living with a roommate at the time, and he's working for a company in the telecom business. And at that time, the wireless industry was really starting to pick up, and he's traveling all over setting up POP sites. And he says to me, hey, you got to invest in our stock because like we're taking off. Like I'm telling you, our numbers are doubling every month. So I had about $200,000 at 27 sitting in the bank, and I took $150,000, and without even doing any due diligence, I went on his word. I put $150,000 into this stock, and it was climbing. Everything's going great until I get a phone call one morning, and he says, "Hey man, you still own our stock?" I'm like, "Yeah." He goes, "Dump it. The CEO's been cooking the books. We've all been let go." I get on the phone. At that time, there's no online trading. You got to pick up a phone and call a trader. So I call a trader, and I wait. I said, "Hey, I want to liquidate this stock." And he said, "It's on hold. There is a hold on it because of now there's fraudulent activity." So the stock got put on hold for about 4 days. And it was trading, at that time, it was trading a little over $1. And when it reopened up for sale, it was at 2 cents. I lost everything. I'm devastated. And I said, I will never allow this to happen to me again. I'm going to educate myself. So I went and did the Canadian Securities course. And it's not that, the course is going to, you can't prevent fraud. There's just so much fraud, and I talk about it in my new and upcoming book about how you can't trust Wall Street because there's just so many greedy people out there that you can't prevent that. However, you can educate yourself in knowing what to look for in companies and when you're going to invest. And so getting to CSC then led me to getting a job with CIBC and worked there for a couple of years, and I started building my accreditation with CIBC. After a couple of years, I realized that my biggest competitor was my own employer. It was crazy because, I'm being based on my performance. I'm getting bonuses, and there's certain thresholds that if you had this amount of money come in, you had to refer it to CIBC Wood Gundy. If you had this amount, you had to refer it over here. And I'm like, man, like you're taking my bonuses away. I can't do shit. And I finally said, enough of this. And I decided to leave. I built some accreditation, let them pay for it, and then I went with a small brokerage firm out of Windsor because I interviewed with TD Waterhouse, Wood Gundy, all these guys. And you know what? When you're starting with them, they take like 55% of your commission, and they leave you with 45, and they give you two years to build up your book of business. And if you're not producing, they walk you out the door. And then it's like vultures. They're all after your book of business. I said, nah, this is not where I want to go. So I went with a really small boutique firm out of Windsor. And I think they had probably less than $1 billion of assets under management, probably around 800 million. And I started building my book of business with them for about 16 years. And I built up a very sizable book of business. And then one day I woke up and I just wasn't happy. You got to love what you do. Like, I know you love what you do. I love what I do now. To me, this is not work.
This is on your face.
This is fun.
Yeah.
But when you get up in the morning and you put your suit on and you're looking in the mirror and you're ready to go to work and you don't like what you're seeing back and you're not feeling good about what you're doing, it's time for a change. And I realized that the information and the the bullshit, the myth that you're trying to sell your clients that the banks are teaching you is not how to create wealth. You're creating wealth for the big institutions, not for my clients. And I kind of looked down, I said, all my wealthy clients, where did they make their wealth? You know where they made their wealth?
Real estate.
Real estate.
100%.
They made their wealth in real estate, not in the markets. And I said, you know what? I need a change. I need to educate people on how to create real wealth. Screw Wall Street, screw Bay Street. I'm going against the grain. I sold my book of business. I gave up my securities license, and I focus on organic wealth building, and that is using alternative vehicles that have tax codes, certain tax codes in them that allow you to create wealth and not pay tax or minimize your tax.
So we're going to really go into that because obviously, look, minimizing taxes is a strategy that more and more people need to know about, and the trusted ones. But before we go to that, I want to just go back for a second because there's something that I need you to unpack for me and more importantly for my listeners. You said that when you invested that $150,000, you didn't do your due diligence. Okay. Now going back, what would you have done differently? What would have been the due diligence, right? Like we hear the word a lot. Yeah. Make sure you dot your I's and cross your T's and all that kind of stuff. But what would you have done differently?
Well, there's only so much due diligence you can do. Again, it's very hard to prevent when the CFO and the CEO are cooking the books. It's very hard. However, when you're looking at a company, you need to start looking at price to earnings ratios, start looking at their financial statements. You need to take a look at their trading volumes. Okay. Kind of get to know who are the directors who sits on the board of directors and what other boards do they sit on, and kind of track those companies to see how those companies are doing. Mm-hmm. Right. Now,
when you say trading volumes, what do you mean by that exactly? Like, because I know there's people who are watching and listening. They're like, some of these words are just going to go over their head. Are you talking about how many people are actually investing into the company?
Well, no, you kind of look at the 50-day week moving average. There's a moving average. You want to see the volumes in 50, if there's like spikes and then real lows and stuff, you kind of want to see like, you know what? I do love banking stocks. I love bank stocks because they pay a dividend, and you don't see this with bank stocks. You see their earnings come out, and it's a very steady. It's a very like smooth little roller coaster. Mm-hmm. But they pay a dividend, right? You know the earnings. You know the history of the companies. This was a very new company. Right. They literally just got listed on the TS. Back then, it was the TSE. Okay. The Toronto Stock Exchange. Now it's the TSX. But there's very little known about the company, but you got to research the CEOs, board of directors. You got to be basically on the inside. And this is why I kind of go against the grain and I don't like Wall Street anymore, because when it comes to trading stocks, there's a winner and there's a loser. You got a buyer and a seller. Someone has to win, someone has to lose. And in most cases, you're on the losing end. Why? Because you're not on the inside. You don't know things that are going on the inside. You don't know information that only a lot of the inside traders have. So most of the time you are at a disadvantage, and 9 out of 10, you're going to lose.
And so how much, and then you said financial statements, how much access does 𝘄𝗶𝗁 have to like some of the financial statements of some of these companies? And what should they be looking at when they're actually looking at the financial statements?
A publicly traded company has to publicize their financials. And they have to be, because they're on a trading exchange, they have to be audited financial statements. So that's important.
Very important.
Okay. It's not just a reviewed financial statements or notice to reader. Notice to reader, anybody can do.
It's like a fucking memo. Anybody can just send that from internally from the company, and it just goes, yeah.
And reviewed basically says an accountant double checked his numbers. Yeah, it works. But audited, that's like forensic. They're going deep.
And we're probably looking for like a company that's like an accounting firm that actually like a third party, and you want to make sure that you check their credibility as well, right?
Yeah. You want to look at like a KPMG. Peat Marwick and Thorne, there's BDO. Then these guys, they're
the big boys.
They're the big boys, and when they put their name and their stamps as these are audited, we are certifying that what these say is true. So when you look at financials, you kind of want to look at their earnings. Like, how much is their earnings, each quarter? Have they gone up? Are they drastic? Are they up 20%, 30%? That's kind of, I would take a look and say, well, why is this happening? What happened during that year, or during that quarter to make these earnings so high? And I would take a look at previous other years and compare the financials. Right?
Like do a real deep dive, right? I like that you mentioned that, John, because like some people will be like, oh my God, okay, this last quarter it went up by 30, 40, 50%, right? And you have this massive spike. But I mean, guys and gals that have been in the game for a while, we generally know anything that goes up that fast is gonna come down. It's gonna come down, right? And so, look, I know everybody's looking for the quick buck, but it's very difficult to find, right? Like in real estate and stocks. And so I like what you really said there, because you do need to do that deep dive into the numbers and say, okay, it went up. Now if you compare it to the year before, if those records are available, and you didn't really see that in that third quarter of that year, you need to ask more questions. I think it really comes down to that, right?
Absolutely. And if you want to trade stocks, by all means, I'm not going to say no, don't do it. What I'm going to tell your listeners are, if you want to trade stocks, be prepared to spend at least 10 hours a week researching these companies. If you can afford 10 hours a week, then go for it.
Right.
Feel good about it. And then people say, okay, well, I don't want to do stocks. Let me jump into a mutual fund. Okay. So what is a mutual fund? A mutual fund is a basket of stocks, 30 to 50 stocks in a certain sector or demographic. And now you have management fees. So I say, okay, you know what? I'm going to buy a U.S. stock. I'm going to buy Canadian equity. Canadian equity may have, the 30 top companies listed on the TSX and trading, and they're going to charge you anywhere from probably 2.45 to 2.65 management fee, which is called an MER, to manage that fund. Now, that fund has to do, if you're looking for an 8% return, that thing's got to do 12.5 to 13% gross for you to earn 10.
Now, and there's not, if you look at the history, I mean, there's not that many mutual funds that are seeing 13% like year over year growth. I mean,
no.
Right? That's just not really out there.
It's, you might get a couple that had a great year, when the, the Canadian markets are up and things are going well. Listen, when things are going well, all stocks are doing well. Right. I can close my eyes and throw darts and hit something, and it's going to do well when the markets are doing well. It's the same as in real estate. You saw in 2020 and 2021, you can have a piece of shit house and list it for something, and you're going to get 200,000-300,000 over ask because it's a crazy market. It's just everybody wants something.
You could have owned a parking fucking spot in downtown Toronto and made a heap of money in the last couple of years, right? Like, it's just, you're right. When things are really good, people are very, very aggressive. But then I like to look at it from the perspective of it from a 10-year window. Yeah. Right? I'd like to say that don't be a day trader, be a decade trader. And if that comes down to stocks, investments, like real estate, building a business, relationships, like there's a lot of shit that can happen in a year. Things are going to go up, things are going to go down. But what does it look like in a 10-year window, right? And for me, that's why I always come back to real estate. But you said it earlier, like you're not trying to tell people, and I'm very similar to you in that sense, John, that not to invest into stocks, not to invest into mutual funds, because we also know hundreds of thousands, if not millions of people who are multimillionaires and billionaires through investing into mutual funds and stocks. Like that still is going on out there, obviously. It's not just real estate. When it comes to stocks now, like if somebody who's listening now, would you say move towards more of mutual funds, even though you're not going to see that 8 to 13% necessarily, because there's a little less risk involved with a mutual fund? I feel like there is, because you get the basket of goods. Would you agree with that, disagree with that?
The mutual fund companies and banks are going to hate me, but that's okay.
Okay.
I love the haters, and I like to go against the grain.
For sure.
I'm gonna tell people what the banks and stuff don't want you to hear, because this is the shit that they're forcing down your throat. Buy this mutual fund, stick it in your RSP, get these returns, reduce your risk. It's bullshit. because of the high fees you're giving away, you're leaving so much money out there on the table. If you want to participate in the markets, here is my advice. Buy an S&P 500 ETF. Go to Vanguard. It's not a plug for Vanguard, but Vanguard has one of the lowest rates. You can buy an S&P 500 ETF for 0.2%, less than 0.25%.
That's the fee.
That's the fee.
Okay.
And now when you're buying an S&P 500, you're participating in all 500 companies. So whatever the S&P does that day, and I'll tell you, over a 10-year period, the S&P has given back 9.6%. Average.
Nikki, can you just check for us? What's the S&P at right now? Just to kind of get an idea. Like what is it trading at right now? And is that going to include all the big boys like the Apples of the world? But
you got the Dow Jones, the Dow 30. So those are the 30 like kind of tech stocks.
Yep.
And then you got the S&P 500. You got Disney, AT&T, UPS, Federal Express, all these big companies. But now you're participating in the movement of all 500 companies. So now you're really reducing risk and you're paying 0.2%. You're not giving these managers 2.5% away, because if you take a look at all management fees, I'll give you a real quick, easy tip. If I was being charged just a 1% management fee and I was getting 8% a year, I will in 30 years give away 1/3 of my wealth just to fees. Just to fees. That's 1%. Now you've got managers that are charging a 2.5 to 2.6 MER on an equity fund. That thing has to do 13%. Now you've got taxes too.
Right.
So if you're not sitting inside an RSP, which is, by the way, is the biggest scam the government's ever created.
We're on the same page there.
Okay.
We're on
Huge scam.
Yeah.
You got to pay the tax on that if it's sitting outside the RSP. So most people, I would say, anything that's going to be highly taxable, put inside your RSP if you have an RSP. Things like equities is going to be treated as capital gains. Put those inside a TFSA or keep them in the non-registered, because it's treated as a capital gain. It's not interest income. So interest income is going to be taxed the highest. So it's things like bonds, GICs, hold those inside your RSP where you defer the tax. People don't save the tax, you defer the tax.
Yes. You can never get away from taxes. The same.
No.
Well, sorry. We're going to talk about that, but I mean, like, the average
Yeah.
person should know that, generally speaking, the two things that are coming that you're always going to pay is death and taxes.
100%.
Right? And now, if you don't find ways to shelter this, which we're going to get into, you're going to end up paying a lot over a long period of time. Nikki, I know you got something for us.
Yeah, so the current value is $4,391.30, which is down 1.25% today.
Okay, so now, and what has it been trading for in the last 10 years?
Yeah, if you go with the S&P 500 10-year average, I think it's about 9.6.
And now, see, that's why I'm going back to being more of a decade trader.
Yeah.
Right? Like, it's down today at 1% or whatever Nikki's number was, right? But if you look at it over 10 years and you just hold on to it, and then that beautiful, beautiful word compounding, that's how you're going to create wealth over a long period of time.
Seen some weird numbers.
Okay.
So from ycharts.com, it's saying the S&P 500 10-year return is at 156.3%.
Well,
That's not the 10-year average.
that's not going to be the 10-year average.
That sounds wrong.
Yeah.
But
See what comes up there.
a few times here.
While Nikki's looking for that, let's jump into
12.15.
There you go. Even a little bit higher than what you were saying. So it's even better. Let's talk about some tax strategies.
Yeah.
So how does this all work? Like walk me through it, because I'm obviously very interested in it, but I got a lot of people who are watching and listening who are earning significant income, and they want to learn ways to minimize their taxes, man.
Yeah. So the strategy that I use is great because it also helps people in real estate.
Okay.
So I've got a book coming out. It's called Wealth Without Wall Street. It's taking back control of your money in a rigged financial system. And I teach people how you can create wealth without having to invest in the stock market. Okay. And I always talk about real estate and whole life insurance. Okay. And when people hear whole life insurance, people say, that's a scam. Why do I got to invest in something that I'm never going to see? It's a death benefit. I don't want to make someone rich. But what people don't understand is that the word life It's not death insurance, it's life insurance. So you get to use it. I'll show you how to use it while you're living. You get all these living benefits, okay? The great thing about whole life insurance in Canada and in the US are the tax provisions that are inside of it. You can build up a shitload of cash value inside of it, and it grows inside tax-free.
Okay.
And I'll show you how to access all that money tax-free. And you can even use it to buy real estate. You could use it when you retire and take a loan, a collateral loan on it, and get tax-free retirement income for the rest of your life. So there is a way to reduce and avoid legally how much tax you pay.
Okay.
You just have to know the strategies. If you take a look at a lot of all these big real estates, like I don't know if you're a big follower of Grant. I love Grant Cardone.
Yeah. I've had him on the podcast.
Yeah,
Yeah, awesome
great
guy.
guy. I just met him at the multifamily conference last month.
Last month. Yeah.
Yeah. And, people get upset at all these, multimillionaires like Donald Trump. Why didn't he pay tax? He knows how to leverage real estate. You can't tax debt.
I mean, 𝗵𝘁𝘄𝘄𝗃, another guy that I've had on the podcast. I mean, most people who talk about stocks and real estate will know his book, Rich Dad, Poor Dad.
Yeah.
This is what he talks a lot about. And these are the types of strategies, or when people hear them on podcasts, or maybe if they go to a seminar or something, it just glosses over them, man. Yeah. Like they just don't understand. And so that's why I'm so glad that you're very familiar with this, because we're going to be able to really do that deep dive into the actual strategy. So, for example, let's just fictitiously use some numbers here. Let's say somebody's earning $500,000,
yeah.
Okay, in their business, or they're self-employed. Okay, now they have expenses. They have business expenses of, let's just for easy math call it $100,000 a year. Now they have $400,000 that generally in a normal circumstance that would be taxed.
Yeah.
How do you help with, how does your strategy start to take over now?
Great question. Okay, so real estate agents, we're now allowed to have PRECs.
Yes.
Okay, a PREC is a professional real estate corporation that we can now have money paid into a PREC and get taxed either at 12, 15%, or 20%, instead of having $500,000 taxed to me and Trudeau taking 53% of it. Okay. So when the money goes into your PREC, you say, okay, I'm going to take $100,000 salary.
Yeah. For me as Jas Takhar.
Right.
Yep.
So I'm taking $100,000. Now I'm going to keep my tax rates probably in the mid 30s, because we have an average rate and a marginal rate. Your marginal rate is going to be what the next dollar is taxed at, but then we all have these increments, these bumps. And when you take the average rate, you're going to be at $100,000. You're somewhere in the 33% mark. Okay. So now you've got this money, $400,000 left over in your corporation. How does Jas get that money into his pocket in the most tax efficient way? There's a couple of ways. Inefficiently would be taking it all at T4. You don't want to do that,
because that's going to get taxed again
at the highest rate.
At the highest rate. So call it 53%.
Right. So then an accountant may say, well, you can take some T5 dividend income.
Yep.
Okay. So now you may pay, if you paid the lowest corporate tax rate, you're going to pay the highest dividend rate. So it's around 47% dividend rate.
Okay.
Still better than 53, but not great. And if you've paid the top corporate tax rate, you're going to pay a dividend rate around 43%.
Okay.
Not bad. A really smart accountant will say, hey, we can do a capital gain strip. We'll get it out at 27%. And a capital gain strip says any Canadian-controlled private corporation has a lifetime capital gains exemption of about $938,000. So basically what he's doing, he's stripping down your lifetime capital gains, and he's going to get it taxed at 27%. But I could do it at 0%.
Okay. And really quickly, John, just so I'm following.
Yeah.
When you said lifetime at 930,000, if I weren't to do if I didn't do any type of strategy that you're speaking about, year 2, if I had another 400,000, he can only start to strip this so much over time, right?
Correct.
Okay, so I am following. Continue.
When you strip down your capital gains down to 0.
Right.
Okay.
You're done. You can't do
You're
it
done.
anymore. That's it.
Yeah.
Okay.
Now the only way to get that money out is T5 income.
Yeah. Okay.
Or it's a dividend.
Yep.
Right. So what I teach all my business owners is, you've got money sitting inside your either your operating company or your holding company, okay, and you want to get this money out. So what you could do is you can now purchase a whole life insurance. It's corporately owned life insurance policy. So your corporation is the owner. Your corporation is the beneficiary.
Not my
it's on your
prec,
life.
not my prec, another holding company.
You can set up a holding company.
Okay,
I would set up a holding company.
Perfect. Continue.
So the holding company owns the shares of your professional corporation.
Yep.
Okay. So now you can move money up and down between corporations without triggering any tax.
Okay.
Okay. So now your holding company moves that money out into a corporately owned life insurance policy. You're the insured. Okay. Holdco is owner and beneficiary. Now the money moves out into a corporately owned life insurance policy. That's tax-free. Each year you make a premium payment. What happens is there's a part that goes to the insurance, we call it death benefit, and then there's another part that goes to cash value. And you got to be really careful with what kind of insurance advisors you're working with, and I'll tell you why. Some people, unethical advisors, has given this industry a bad name because they say, oh, you know what, you're just trying to sell me the most amount of death benefit because you get paid the most amount of commission. That is true. However, if you're utilizing a strategy like this that you want to build an abundance of cash value in, what I do and what every advisor who's in this business working for their client should do is try and get you the least amount of death benefit by maximizing the amount of cash that goes in. Because what we're trying to do is we're trying to get this money out of a taxable environment into a non-taxable environment. So we want to move as much cash as we can in there. We call this overfunding. Okay. So we get the money in there. Structured properly. Let's just say you moved $100,000
Let's just use the 400,000 as the example.
Well, you got to do this every year. You got to do this every year.
Okay.
So I'll just say, I never tell anybody put all your eggs in one basket. I say do something that's comfortable.
Okay.
So move $100,000 in.
Yep.
You move $100,000 in your first year, you'll have approximately 72% sitting in cash value after your first year.
Okay.
That's a pretty high number.
Yep.
And then in the second year, it keeps growing and growing, and usually you're at the break even by about year 5. So let's just say in year 5 you put in $500,000, you got $500 cash value.
Yep.
Now, you see a piece of real estate, and I'm going to speak. This just happened last month.
Okay.
My wife and I are in Las Vegas for our wedding anniversary, and I've got a listing of a condo in Mississauga, and I'm not getting a lot of showings. I'm like, why am I not getting a lot of showings? What's going on? So I go into the listings to see, has there been any new updates or any recent listings? And I see a unit that is listed at $459,000. My unit's listed at $580,000. I'm like, what's going on here? I see estate sale. I'm like, okay. I used to be in the business of buying homes, and I was a home builder with a buddy of mine. So I said, okay, this sounds good. Let me take a look at the photos. It's a piece of shit. It needs a lot of teal. It's a gut job.
Sure.
So I'm like, I think there's some opportunity here. So I called the realtor and I said, hey, tell me, what's the story on this? He says, hey, my mom inherited this from her uncle. He just passed and there's no mortgage on it and she just wants to get rid of it. I said to him, I'll make you an all cash offer, close in 10 days. He says, submit the offer. I said, I'm the buyer. So I submitted the proper documentation, submitted an all cash offer. I stole it at $450,000. How did I close in 10 days? I don't keep $450,000 in my bank account. You'd be stupid to.
100%.
Okay. I have whole life policies. I make a phone call to my broker, not my broker, but my inside guy, and said, I'm in Vegas. Send me the form. I need to complete a loan an application, but it's a one document that you fill out. The great thing is when you're completing or applying for loans, they're contractually guaranteed. They can't say no. And it's never a credit application, and it's never a credit process that goes through. They're not looking at your credit bureau. It's a private loan between you and the insurance company. Right. So I had them email me the form, which is a one-pager, and I just type in my policy number, $450,000, sign it. In 5 days, the money's in my account. That's it. No credit check. You might think, well, what kind of loan repayments do you have? Right. There are no loan repayments. Okay. The only thing that I know is my interest rate. It's 2 above prime. That's it. When do you have to pay it back? That's up to you. There is no loan repayment required. See, there are 2 types of loans, structured loan and an unstructured loan. Now, if you go to the bank and you want to borrow $450,000, what are the 3 things that the bank's going to tell you? You want to know, what's my interest rate? When do I have to pay this back? And how much do I have to pay each month? Those are 3 things that the bank is going to tell you and you have to sign off. What happens if you miss a payment or 2 payments?
They're gonna, well, if it's whatever it's security, whatever the security is, they're gonna take that.
They're going to take it.
They're gonna take it.
They're going to come take your collateral.
100%.
Now you fucked up your credit bureau too.
Yes.
Right? Now you got late payments. Now you just hurt your credit bureau. When you do a policy loan with an insurance company, there's only one thing that is known. That is the interest rate, because it is called an unstructured loan. It's a private loan between you and the insurance company. If I never pay that money back,
right,
it simply accrues interest and comes off of my death benefit. However, you being the bank, and I teach people how to be their own bank, be an honest banker. Pay it back. Now, I picked up that condo. I'm going to fix it up, and I'm going to flip it in 30 days.
Right.
I should make about 60, 70 grand on this quickly. And I pay it all back into my bank.
Right. Now, most situations won't be like most people in that situation, they might not have been able to steal and get it under market value, right? So they wouldn't be able to flip it like you're going to be able to. So let's talk about, if you weren't going to be flipping it, for example, would you consider refinancing it at a later point and then paying it off?
Yeah. So if I wasn't even going to consider of holding on to this and renting it out, then I probably would have gone to the bank and got a mortgage for it. However, I didn't want to have the penalties and go through the whole credit application.
Yeah, I get that.
Right? It's going to be a quick thing. Like, I've already held it for 30 days. It's nearly done. I don't want the penalties. Right. So it's just, I want to steal this thing right away. I'm going to give you an all cash offer, 10-day close.
Yeah.
That excited his mom.
Sure.
And I'm sure you've encountered this too. When you get into situations where there's an estate sale, it's usually the children that they just want a quick close.
Yeah.
And when I was building homes, I stole a lot of these properties, not because I was always the highest price, it's because I had favorable terms.
Yep.
No conditions, 30-day close. Right?
Yeah, I mean, even when you're just putting in a regular offer for somebody who's like a first-time home buyer or whatnot, it's not always the price. It is the terms.
It's
People
the
think
terms.
it's always the price.
Yeah.
It's not.
And so for your listeners out there, getting started into a whole life policy, it will take a couple of years for you to start to build up your own bank. But once you start to build up your own bank, the options are endless, and you could leverage that into real estate. I mean, you could go certain places like up in North Bay, and you could pick up properties for a couple of $100,000, pay cash for it, and have this money being paid all back to you, and then you can pay it back into your policy.
Right.
But here's the great thing about this. I didn't drain $450,000 from my life insurance. My $450,000 is still there, earning me compounding interest. I use the insurance company's money.
And what type of interest would you normally see on that?
Well, because of where the prime is sitting right now, it's usually prime plus 2.
Okay. And what is the actual process to set this up? And then just before you answer that, John, like you also mentioned a premium. What would the premium be on that payment?
So I've got 3 policies.
Okay.
I started my first policy 17 years ago. I mean, they usually take about 20 years to fully pay off.
Okay.
That'll be paid off in 3 years. So I've got several policies. Some of them, my latest one I did was, I'm putting 30 grand a month. I've got other not a month, 30 grand a year. I've got other policies where I'm putting in $50,000 a year, and another policy when I first started in the business, like way back, I was like 35 years old. I think I'm putting in like $18,000, and that'll be almost paid off.
Okay.
Right. And then I bought one on my wife.
Right.
Because they won't let me buy more insurance. There's a certain amount of insurance or death benefit that they'll let you have. I'm at my max. They're like, we're not giving any more. So I'm like, how do I get more money out of my business? Hey, let me insure my wife, right? So I'm the owner of the policy. It's on her, and I'm funneling money into this policy for her too. So at the end of the when we're looking to retire, I'm going to collateralize all these policies, and her and I are going to have a very comfortable retirement, and I'm not paying a penny in tax because it's all debt.
Now, what is the process of actually getting this set up? So somebody's watching and listening right now and say, okay, this is awesome. Yeah. I understand. I followed along. What is the kind of next steps to get it all set up, and how long does all that take?
Well, you should be in relatively good health, and some people may say, well, I've got diabetes. Hey, I've gotten a person with type 2 diabetes approved, or I've got high blood pressure. Hey, I've gotten people approved with high blood pressure before, as long as it's being controlled. If it's being controlled, maybe buy some pills or something. I've gotten people approved with a small rating, right? So to be declined, you got to be in pretty bad health,
Right.
to be declined. And then it comes down to affordability. There's two things we look at. A lot of insurance guys will say, well, we have to do an insurance needs analysis and we got to figure out, replacing 20 years of income. What's the mortgage on the property? What are your final, expenses, on your death? Yes, I look at all that, but I also take a look at what is your affordability? What is your end goal? I start with the end in mind and then work backwards. Are you looking to fund this as a retirement vehicle? Are you looking to fund this, but you want to have some really early cash values because you want to get into the real estate game? Then there's different ways I would structure it. But it all comes down again to affordability. So if I have a rule. Here's my rule. It's a 50-30-20 rule. 50% of your gross income should go to your fixed expenses, 30% to your lifestyle, and 20% goes to your investment, and pay yourself first. That is number. Pay yourself first before you pay anybody, because when you pay yourself first, you'll never go broke. And
you say it so many times,
right?
But I don't know why people don't understand it. I don't know what it is, and maybe you can help me here. That the simple act of paying yourself first, like everybody's gonna come chasing you for bills. They're gonna get their money. You're gonna figure out how to pay them at some point. I just don't understand why people don't understand the principle more. More people don't understand the principle of paying themselves first. Like, what is it? Like, you probably have heard some comments or you've seen it. Why do people have such a hard time with it?
People like to buy shit.
Dumb shit.
To impress people that they don't know and that don't even care about you.
It's so funny how it always fucking comes down to that.
Buying stupid shit.
Yeah. And not thinking long term.
Yeah, so they'll go into debt.
Yeah.
They'll rack up on consumer debt. You got to figure out, if you're on a salary and you're walking into Louis Vuitton and you're buying a $3,000 purse, how many hours of your life did it cost you to buy that $3,000 purse?
A month's worth.
Right?
Call it, for argument's sake.
Yeah. Right. You just
It's actually
spent
more than a month, but
you just spent the full month buying a purse that no one's going to be impressed.
And the novelty wears off so quickly.
It does. It's 100% the novelty wears off. So I always tell people, listen, what people particularly do is they get a paycheck, they put aside some money for the rent or the mortgage, their car payments, and what's left over, they go out on Friday and they party and, hey, I'm doing bottle service at, this club or that club. And come Monday, they're broke again till next payday. That money's consumed, it's gone forever. You'll never get it back. If you just took 20% and you put it into a separate account and you paid your bills and what's left over, I'm not saying don't go to the club. Mm-hmm. Go to the club.
Mm-hmm. One less bottle, maybe.
One less bottle. But you still got your 20%.
Yeah.
You still got that money. And you do this every week or every time you get a check. Every time I get a commission check, I right off the top, before I put money into my CRA account, before I put money into anything, 20% goes over here. And then when I build up some cash, and then I start divesting it.
Yep. Somebody taught me this when I was just right after the banking, right after I left CIBC. I went into car sales, so I was 21 or something like that. And my guy taught me there. And at that time, because I was still living with my parents, he was like, look, I would normally tell people 20%. I'm going to tell you 50 because you don't have that many expenses.
Yeah.
Now, at that time, I was like, holy shit, 50% of my commission checks, man, that's a lot of money. But because I did that, I was able to take the jump into real estate 2.5, 3 years later with a lot more comfort, knowing I had a little bit of a nest egg. Now, I ate through that fucking nest egg in the first year because anybody knows when you get into real estate, it takes a while to get closings and get checks again. But if I didn't have that, I probably would have to quit real estate or go part-time. But having that nest egg allowed me to stay in the game full-time. Yes, I ate through all that savings, but it saved me from getting out of the business. It allowed me, more importantly, to say, you know what? I can make some more long-term decisions here. I can put a little bit of money into marketing. I can go take a prospect out for a coffee because I run, I hear it all the time with newer agents. Look, I don't have no financial runway. I don't have any money in the account, right? So I know it's boring, but I think you'll agree with me, John, and please add your thoughts to this, that it's generally these boring principles that actually work really well.
Yeah, it's funny you say that because a lot of people, maybe listening say, you know what, I can barely make ends meet now. Here's the truth of the matter. If you can't save $20 a month now when you're broke, the belief system is, I'll start saving when I make more money. No, because when you make more money, then you get what's called lifestyle creep. And as you make more money, you know what? Let me upgrade my car. Let me upgrade my purse. Let me upgrade this. And now your lifestyle starts to creep up with your income, and you're still not going to save money. So if you can't save money while you're broke, you're not going to save money when you make more.
If you can't save 20 cents from $1, you're not going to save 20,000 out of 100,000. Right, because the habits are not there.
Yeah.
Right, and our late great friend 𝗵𝘁𝗵𝗹 said that more money, more problems. I think it's more money, like different problems. Like you make more money, and then you just have different shit to deal with. Like I'm making more money, but now I have more staff, and comes with that, then fucking guy like. Something breaks, you know what I mean? So and equipment breaks, shit gets stolen. Like you just have different shit that happens.
Yeah.
And so don't think, and I love what you said, man, like if you're not gonna be able to save when you're broke, you're not gonna do it when you make more money because you don't have that fucking habit. It's the habit when you're making $1, whatever it is, $30,000 to save that $3,000 a year, because when you make $300,000, you'll understand, shit, I got to save the $30,000 now.
Yeah. Listen, people say, going back to your point, more money, more problems. Yeah. Maybe being wealthy is hard, but so is being broke. Choose your hardness. I'd rather be wealthy and have a hard time than being broke.
Now, what are some other ways other than just like, because I know we beat this down to death, and then hopefully somebody gets it. Just that one person out of all the people that are listening, I'll be happy if they just take on this new strategy of paying themselves first. But somebody in that 20 to 30 year age gap there, what are some other tips for them to start to create wealth?
I'm glad you mentioned that age group, because I've got 5 rules to money. We just discussed rule number 1 is pay yourself first. Okay. Rule number 2, money's a game, and you got to know how to play the game. It's a doubles game. Okay. And what I mean by doubles game is you got to understand the rule of 72. And the rule of 72 is basically a mathematical formula that says, if I'm earning a certain interest rate on my money, how long or how many years before my money doubles? So if I'm getting an 8% rate of return on my money, it's going to be 9 years. You could divide the 8 into 72. It's going to be 9 years before my money doubles. So I always say, understand the game and get started early. You got to get started early. Some people say, well, let me pay off my house, or I want to pay off this house, I want to pay all that off, and then I'll start later. That's the wrong mentality. Here's why. It's a really simple formula that I actually put in my book. If you took a penny a day and you doubled that penny every day for 30 days, do you know how much money you'd have in 30 days?
I used to know this number off the top of my head. What's the number now?
$5.4 million. Yeah. A penny a day, 1 cent goes to 2 cents to 4 cents, then to 8, and it just doubles for 30 days. And then on the 30th day, it's $5.4 million. But how much money would you have if you delayed and started on day 15?
Exactly.
$1.96.
Or if you started $1 million, look at that big difference, right? And what I think will happen with a lot of people is that they just run out of patience, right? Like, and they're just like, it's taking too long, right? But it's that day 20. Like, when does it really jump again? Like, I forget. Like, is it like day 28, 7 or something like that?
Yeah. Well, if you go work backwards, so on day 29, it was 2.7 million.
There you go. Exactly.
Right. And then on day 27, it was, half of that. So the doubling, they go, 1 cent to 2 cents. That's nothing. Yeah. But it's really great at the end. So get started early because you want more doubling effects.
For sure.
Okay. So pay yourself first. Understand the rule of 72. Understand the money game. Get started early. Create velocity with your money. Put your money to work. Don't let your money be bored. Right? If you're dating a girl and you're boring, is she going to stick with you?
Not that long.
She's gone.
Yeah. And boring could mean in any aspect too.
Right? If your money's bored, it's going to leave you. And what I mean by that, if you're not creating velocity like the banks do, if you just got your money sitting in a bank collecting 0.01%, your money's being eaten away by inflation.
Silent killer.
Right? Exactly. So what do the banks do with your money? You put it on deposit, they give you 0.1%, but they lend it out, they rent out your money. Just take a look at the 5-year fixed mortgage rate right now. You're looking at 5.79. They're renting it out 5%, or you get a line of credit, you're looking at 7%. So they're making X amount of dollars. They're creating velocity with your money. So you got to create velocity with your money. And my 5th rule is don't be a hater of money. Respect it. You know, some people say, I don't know if you've heard, I've heard it many times, oh, money's not everything. And,
it's the root of all evil. That's
money's the root of all evil.
That's the one that we hear a lot of.
You know, the people that are saying that is the broke people.
Yep, I agree. And there's this scarcity mindset around it.
Oh my God, 100%.
Right? Like, it's like, well, fuck, if John's making it, he's taking off of my plate.
Yeah.
Right. And I think when you come to realize, and please, elaborate on not being a hater on when it comes to money. But for me, it's always understanding that if you can help other people make money, you'll have more in your life than you've ever dreamt of.
You have no idea how true that is. Because since I started on my journey, when I sold my book of business in 2016, my goal is to help as many people and educate as many people as possible on how to create real wealth. And that's why I wrote this book. It took me 4 years to write this book. I started just before the pandemic. And it's a big book. It's 83,000 words. It's going to be about 280 pages.
When's it coming out?
Hopefully it's in the publishing right now.
Okay.
The editor is coming back with the edit reviews.
Love it.
And we're hoping to have it published and out by Christmas.
Congratulations.
Thank you. Appreciate that. But I want to help as many people as possible to educate them on how to grow your wealth and stop getting advice from the people that are working at the banks, because these people are basically pushing the bank shit. It's the bank product. And I'm going to tell you, the only ones that are making money are the ones at the top. Okay. If you go down to the marinas and you want to take a look at all the yachts, it's the yachts of the CEOs.
Yep.
It's not the customers' yachts.
No.
It's all theirs.
Yeah.
Okay. So who's making the money here? Okay. If you're giving such great advice, how come the customers don't have yachts?
So true.
Right?
So true.
So I want to educate people on the truth about money and how to really create velocity and get your money working for you. You got to put your money to work for you.
For sure.
Okay. And I love the real estate game, because when you start to appreciate, your property start to appreciate, I could refinance and I could take that money out and put it into another property. And I can do that over and over and over and over again.
And people want to give you, going back to the banks for a second, they actually want to give you this money. Like it's
Yeah.
and that's the unfortunate part with stocks. Like I just want to make sure I don't say this wrong. I have no stocks right now. Like so it's not like, again, I have anything against it. It's just not my game. But from what I know, and correct me if I'm wrong, John, you can't like get money from the bank to buy stocks. Like there's really no leveraging that you can do. I'm sure there's maybe a strategy out there. Someone's gonna, rip me on TikTok right now because that's just what they do. But from what I know, you can't do that. And so with real estate, you kind of just need 20% down.
Yeah.
Right. And so you're looking at your $500,000 property. You just need $100,000. If you can, and I know it's not easy to come up with $100,000 for a lot of people, but if you get your $100,000, you now can buy that property for $500,000, but your return is going to be based on how much that value goes up on that $500,000. Where in stocks, to compare an apple to an apple, you're going to need the $500,000 in cash.
Yeah, try walking into a bank and says, "Hey, I want to borrow $500,000 to buy a stock portfolio." They're going to laugh at you.
Exactly.
That at the very most, they're going to take a look at it and say, "Okay, we'll lend you 50%, but we also want $500,000 in collateral in case, because we know how volatile these stocks are. They're not going to give you 100%." But just back to your point, I can go and buy $1 million property, put $200,000 down, and the bank will happily give me $800,000 on that property. Now, let's say that property goes up 10% in 2 years. I just made $100,000, but I only put $200,000 down. I'm up 50% cash on cash in 2 years. You show me anything out there that gets you these type of returns, without the type of volatility like real estate. I think real estate is the number one asset creating wealth for people out there.
And we said it earlier, right? Like, I think the statistic that's always floating around there, that 90% of multimillionaires were created own real estate as an investment, right? Like, it's in their portfolio of businesses and some stocks and mutual funds, but a lot of them, 90% of them own real estate, and not necessarily their principal residence. And this might come off weird to some people because I'm a real estate agent and we get paid when people buy their properties that they live in, but I'm a big proponent of this. Like, you do not need to own where you actually live. You can rent that property yourself as long as you take the money and buy income properties, right? And I think it's important, and please, like, add your thoughts as always, but I think it's very important for people to understand that. Now, with that said, I do believe every single person, especially my guys who are 25, 30, you should get in the market once as like maybe even as a principal residence, because it allows you to build that equity quite quickly, but don't get caught up in what other realtors will tell you, that you have to own where you live. You just don't have to. Like, fuck, I do own where I live, man, but every 7-8 months, I wake up and I tell my wife all the time, I'm like, hon, maybe we should like just sell this, take the money, buy a bunch of income properties and rent, because I don't fucking like having the grass cut. I hate figuring out that the AC just broke and now I gotta fix that shit. I would rather the landlord deal with all that stuff. Like this studio that we're sitting in, I don't own this place. And a lot of people who come in here, they're like, oh, you own this? And I'm like, no, I rent it because next week I can pick up and leave. I can just decide to get out of here. Yeah. I'm not that guy. I'm not going to fuck the landlord. I really like him. Shout out to Andre. But if I wanted to, I could. And when some things go wrong, like, the dishwasher wasn't working, I give him a call and say, Andre, you got to fix your dishwasher, bro. Where at my house, I get that text from my wife. Honey, I need you to fix the dishwasher, right? So, but you were going to add something to that.
So it's so funny you bring this up because just last weekend I was in Denver for work, and I don't own where I live. I rent. I always say, own real estate, don't own where you sleep.
Huh? Okay. I like that.
I own real estate. My wife and I, we have several properties, and people may go, "Oh my God, you don't own your home?" No. When you go on vacation, do you buy the hotel or do you rent a room? You rent the room because you're not there forever. There's no sense in buying it. Whether you own or whether you rent, you still have to have a place to sleep. True? Mm-hmm. Okay. I still have the same rights whether I own or whether I rent. Okay. I think I have better rights as a renter.
Say more for sure.
More as a
renter.
Tenant,
a lot
way more rent.
Yeah,
right.
Especially in this province.
If I really wanted to, I could fuck the landlord and say, I'm not paying you for a year, and guess what? You can't kick me out.
Yeah.
I know this.
Yep.
Okay. So the home I live in is probably about $2.3 million. I got this place, and what really woke me up was when I went through when I went through a divorce and I had to sell my property, and all the money went into the lawyer's trust fund, and I couldn't access that money, and I had a shitload of equity in my house. And during that time, I had to rent for the first time in 20 years. I had to rent. I'm like, oh my God, I feel so low. I'm at a renting stage. And then I started listening to the Grant Cardone videos. And here's a billionaire who doesn't own where he sleeps. He owns a couple $1 billion in real estate and says, unless you're a multimillionaire, you don't need to own where you sleep because now you're stuck there. As a renter, you can get up and move around. So going back, if you want to talk numbers, I pay $4,000 a month to sleep. Now, if I was to buy this house today, it's $2.3 million. I put 20% down. I got to put $460,000 of my cash down. What am I doing? I'm giving up access, control, and liquidity to my money. I'm putting $460,000 into a home that I'm not going to be able to access that equity. That is what I call equity jail.
Yep. And not to talk about the fact that your payment instead of $4,000 is probably going to, off the top of my head, it's going to be around $10,000. Call it. It's going to be your payment.
$10,700.
Is it there? There you go.
$10,700.
There you go. Plus your property tax, right?
I'm over 11 grand. I'm up 11. I worked it out. I'm $11,500 out of my pocket after tax dollars to sleep.
Exactly. Where you could do that for 4,000, still have your 460 Gs, where with 460 grand, you can at least buy
Two.
In the GTA. I was going to say, like, if you really want to keep it in the greater Toronto area, 2 income properties, and your return is going to be higher.
And
like,
that's what we did. That's what my wife and I did.
black and white. I love it.
We bought 2 income properties.
There you go.
Right?
There you go.
And now those properties are cash flowing. Now, with the interest rates, I may not be breaking even.
Yep.
Right? I'm not making, $100 or $200 a month, but it's producing cash flow. That to me is an asset. Your home is not an asset.
Yep.
The way I look at assets put cash in your pocket, liabilities take money from your pocket. Having a conversation with my sister last night, and she said, we've got our home and, we're mortgage free now. And I'm like, do you think that's an asset or is it a liability? Oh, no, it's definitely an asset. Really? How much did it pay you last month? Oh, it didn't pay me anything. It took money out of our pocket. Your home is a liability. Real estate is an asset. It cash flow produces. And when my equity goes up, I can refinance that and I can go purchase another one. I'm a big believer in owning real estate. Don't have to own where you sleep.
Yep. And I like that we kind of came full circle and talking about assets, because you want to use those income producing assets to purchase some of your liabilities, like that lifestyle that we're talking about. That's why I think it's so important for the younger generation to understand that use social media for the positive attributes that it does provide, because I think it does give a lot of positivity, vibrations it still puts out there. Like, your brain will always find what it's looking for, right? And so if you're looking for inspiration, you're looking for strategies, your brain will find it. It's on social media. On the flip side, if you're looking for the negative, your brain will find that as well. Yep. And I think one of the negatives for the younger generation through social media is when they start comparing themselves to other people, right? Like, holy fuck, John's making this kind of money doing this, and like now I need this as well. Yeah, but you don't know John's story. Like, hopefully through this podcast now, you know a little bit more, but we don't know how hard you had it and how many hours you put in. And, Kobe said it, God, rest in peace to Kobe Bryant. I mean, he said it, you never saw me practice in the gym. Right. And so I think the younger generation needs to understand that comparing yourself to other people is really the fucking poison. Like, that is the number one thing that I hope that I put out enough in the world to stay away from that shit.
Stay in your lane. You don't need to be comparing yourself to the Joneses or the Smiths. Stay in your lane. Work on your own shit. The best thing that you can do is invest in yourself.
So true.
That is the best.
It's going to give you the biggest return.
I'll show you how to take $1,000 and turn it into $1 million. Mm-hmm. Take the $1,000 and go do some fucking courses.
Yes.
Go get some education that is going to take that to the next level. That will get you the $1 million. Don't take $1,000 and put it in stock. Put it in yourself.
It just made me. I was thinking of Jas. Jas, you've been with me for how long now? 3 years or something? No, 2 years. 2 years. And what did I say to you when we first met? I was like, Jas, you and I have a funny feeling. We're going to be together for a very long time, because he's kind of like my personal cinematographer, kind of building a documentary for the next 10 years. And I was like, well, fuck, you got to be with me for that long now. And I said to him, you know what's going to happen, brother? Because he was, what were you when you came to me? 21? 20. And as a 20-year-old, he saw me. He's like, holy shit, Jas, like, sometimes you spend a lot of money on things that we probably don't need all the time. Like, there might be a software that we're buying. There's equipment that we're buying. And I said to him, I was like, in the lifetime that we know each other, I'm probably going to spend $1 million on dumb shit that most people might think is dumb shit. Let me rephrase. But it's going to be us learning things. We're going to learn what's worked well, what didn't work well. We're going to be investing in flying to seminars, flying to meet people. We're going to build a studio. Like 2 years ago, like, this was just a dream, right? Some people are like, what the hell are you just wasting rent on some type of studio? Yeah, but I get to sit down with the likes of you. I learned something today, but I had to invest that money. I think what hopefully more people do is not see things as expenses, but investments into themselves, right? It's upgrading mics, it's upgrading cameras, it's upgrading lighting that is going to bring the likes of you to this couch, and others where I think most people see it as it's just a waste of money, you flying and going to some type of seminar. But man, you learn one thing from that seminar. The new book that John's going to be coming out with, like, you learn just one thing, one strategy, one tactic that you actually implement that can make you way more than $1 million.
100%. I'm traveling a lot for work. And when I say it's for work, it's because I'm doing a lot of conferences. I was in Denver last weekend. It was a mastermind. 26 of the top people in the insurance industry. It was like a TED Talk. And, one guy would speak for an hour, another guy would speak for 20 minutes, some guy would speak for 40 minutes. But we had 26 speakers over 2 days. And man, I'm constantly taking notes, and I've been in this business for 24 years, and I still don't know it all. The day you think you know it all, you're done. You're done. You're constantly learning. I'm 52 years old, and I'm still learning every single day. And when I go to these masterminds, I'm meeting with guys that are doing way better than me. I do well, but these guys are really doing well. And I learn from them, and it's not just learning, but I'm making new connections. I made so many fantastic connections with people that are in the U.S. They're saying, hey, I want to partner up with you. I saw some of your social media stuff, and I got a lot of listeners that are in the U.S. or in Canada that listen to my show. Can we partner up? Can I send these guys to you? Because I like your shit. And I know that you know your stuff. I'm like, yeah, man, let's partner up. Let's do something together. Mm-hmm. So it's not even just what you learn. It's also the connections that you're going to meet along the way that can further your business.
I mean, real life, right? I mean, the reason you and I are sitting together right now is a mutual friend of ours, 𝘀𝗍𝘄𝗄𝗃, right? Big shout out to 𝘀𝗍𝗄𝗃.
Thank you, Luke.
Yeah, right. You wouldn't think when you look at him, I think he just turned 23 a couple of days ago, actually, that how like sharp he is, I think sometimes his young boyish looks fool people, right? But he's doing exactly what you're talking about, right? Like he's making sure that he's getting in rooms at the I don't want to I forget the name where you guys are connected at the group,
the National Club.
The National, I apologize. Like he's, as a 22, 23-year-old kid, he's rubbing shoulders with 53-year-old man who's been through a lot more, and you're putting him in touch with other people, right? And so the old school way of meeting people, belly to belly, works very well still till this day. Not to say that you can't do it on social media, because I think that it's now we're able to do it right across the world, and so it's scaled. But don't forget that old skill of just meeting people belly to belly.
Grant Cardone, I don't want to steal this, but Grant Cardone said it in his book, The 10X Mentor, and I love it. Your net worth is your network. Mm-hmm. And I love what Luke is doing, because he's a very young guy, very charismatic, very professional, upholds himself very well. He doesn't carry himself as, a 22-year-old. He carries himself as a much older, I'd say in his 30s. He's very professional, and when he speaks, and just his character. And by him joining the National Club, he's probably one of the youngest guys in the National Club. Like, he's rubbing elbows with a lot of the big Bay Street lawyers, the Bay Street traders, business owners, accountants. Like, a lot of these guys, I mean, I'm 52, but I feel like I'm young with some of these guys. For sure. And he's putting himself, he's building his network. And he's going to eventually build his net worth by doing that. They say you become the average of the 5 people you hang around with. So just take a look at your circle of who you're hanging around with. And I like the circle that Luke has put himself in, because when I do my cigar nights, almost everybody at that table is either a business owner or they are doing extremely well with their life. And I see that we're always talking, and he's educating himself, and he's making contacts. And I love that. I love connecting people together to help people further along their journey.
Next time you see him, just call him the Phenom. That's his name. That's his name around our office. Yeah. And I think what he does really, really, really well is he understands that he has 2 ears in one mouth. And so he's been with me now for coming up to, I think, 3 years. But that guy definitely listens not even twice as much as he speaks. It's probably like 10 times. He says very little. because he kind of knows his place. Like he's in that mode of being a sponge and soaking it all up. But John, I mean, I think you'll be proud to hear that he literally runs a division of my organization in my real estate company that probably does a little over $3.5 to $4 million a year, ran by the 22-year-old kid.
Amazing.
Like that's his gig, you know, and that all happened because he surrounded himself with people like at your cigar table, right? At the National. And so for somebody who's listening, who always wants to have a little bit more and they're thinking about how can I better myself? It's what John said, right? Really look and audit. Who do you spend time with? Yeah. And it's not necessarily me saying like cut out your brother, your sister, your best girlfriend, your best, you know, your best
Don't be a
homie
snob.
that you grew up. Yeah, like I'm not saying cut them out fully, right? But maybe you can start to look at, can I cut down some of the time? Like if it's 30 hours a week that I spend with this person, can I cut that down to maybe 15? Can I cut it down to 20 and just get back that 10 hours? Because maybe you can spend that 10 hours learning about that company that you wanted to invest into, right? Like, so actually bringing it full circle. John, my man, I want you back. I want you back once the book's out, because then we're going to hold it in our hands. Okay. All right. And I'm going to get a signed copy from you. And we're going to talk about everything that's happened leading up to you putting out a book, because I'm very, very curious to hear those stories of all the ups and downs. I haven't written a book about my journey. We've written like a real estate book, but not like my journey. And so I'm very curious to hear kind of your thoughts and your stories around that. And so if it's next month, if it's December, if it's a year from now when it actually happens, I got my fingers crossed that it happens when it's supposed to happen for you. I want you back, and I want to say thank you for not only being all dressed and stuff, but thank you for your time today. I really appreciate it.
You know, it's funny. I feel like I could sit here for the next 3 hours and we could talk wealth and real estate, because this is such a passion, and we both share this passion together and helping people. For sure. And when you enjoy what you're doing, it doesn't feel like work, man. I feel like I could just sit here and order some luncheon and we can sit.
Oh, fuck, that's what we do, man. We'll get the gin open there behind Nikki. I'm sure there's some vodka there somewhere. And maybe the next one we'll light up some cigars and shoot the shit. We'll bring Luke on as well, just to have him here. He was on a couple of podcasts as well, but I really appreciate your time, brother. Thank you so much again.
Thank you so much for having me.
All right, take care.
It, man.
All right.
Thank you.